As of Saturday, January 3, 2026, the stock market is currently closed for the weekend. The final trading session for Nvidia stock concluded yesterday, Friday, January 2nd, with the share price finishing at $188.85. This represented an intraday increase of $2.35, or a gain of 1.26% on the day. The session was marked by significant volatility as the broader technology sector grappled with shifting treasury yields, but Nvidia once again proved its resilience, closing near its session highs. While many retail traders are looking at this 1.2% move as just another green day in a long-standing bull run, there is a much deeper story developing beneath the surface of the order flow that most people are completely missing. The expectation in the market right now is that the Blackwell chip cycle has reached its peak pricing power, and that we are entering a period of digestion where the major cloud providers will slow their spending. However, the reality we are seeing in recent supply chain data and institutional positioning suggests the exact opposite. We are not at the end of a cycle, we are at the beginning of a massive architectural shift toward the Rubin platform, which has reportedly already reached the tape-out stage. This means that while the public is debating whether the AI trade is over, the biggest players in the world are already locking in capacity for 2026 and 2027, creating a demand floor that the bears simply haven't accounted for in their valuation models. If you look at the recent activity on leading platforms like Interactive Brokers or the Fidelity trading platform, you will see a massive influx of capital into Nvidia stock and related semiconductor trackers. Most investors think they understand the Nvidia story because they know about ChatGPT or large language models, but the common belief that Nvidia is just a hardware company is the first mistake. The deeper truth is that Nvidia has effectively become the operating system of the modern data center. When you use the Robinhood app or SoFi Invest to buy a few shares, you are betting on a company that has built a software moat so deep that competitors are finding it nearly impossible to cross. This isn't just about CUDA anymore. The recent acquisition of SCHEMD and the integration of Slurm orchestration software means that Nvidia now controls the very scheduling logic that dictates how AI workloads are distributed across thousands of GPUs. This is a level of vertical integration that reminds many of us of the early days of Windows on the PC or iOS on the mobile phone. While people are worried about a bubble, the reality is that the cash flow being generated is far from speculative. In their last report for the third quarter of 2026, the company posted a staggering $57 billion in revenue. To put that in perspective, that is a 62% increase from the previous year. If you are doing your own online investing or seeking investment help, these are the fundamental numbers that should be guiding your decisions, not the noise you hear on social media. The recent trading volume on Friday exceeded 148 million shares, which is quite high even for a mega-cap giant. This suggests that institutional rebalancing is happening at these levels. When you see big blocks of shares moving through a Fidelity brokerage account or via Schwab Intelligent Portfolios, it tells you that the smart money is not selling the top. They are building positions for the next leg higher. We saw a similar pattern with Apple stock and Tesla stock during their respective runs to dominance. Investors kept calling for a top based on price-to-earnings ratios, but they failed to see that the earnings were growing faster than the stock price could keep up with. Right now, Nvidia is trading at a forward PE of roughly 46. While that might look expensive compared to a traditional industrial stock, it is actually quite reasonable when you consider that earnings per share are projected to grow by another 40% or more as the Blackwell Ultra chips begin shipping in volume. The tension between the expectation of a slowdown and the reality of accelerating demand is where the opportunity lies for those who know where to look. For instance, rumor has it that ByteDance alone is preparing to spend upward of $14 billion on Nvidia AI chips in 2026. If that single order comes to fruition, it essentially de-risks the entire first half of the year for Jensen Huang and his team. Let's break down the recent price action because it tells a very specific story about investor psychology. Over the last month, the stock has been consolidating in a tight range between $175 and $195. This is what technical analysts often call a high-level base. Every time the price dips toward $170, we see massive buy orders coming in from Fidelity mutual funds and large pension funds. They are treating these pullbacks as a gift. If you are using a self-investing approach through the SoFi trading platform or perhaps managing your own individual brokerage account at a place like Interactive Brokers, you've likely seen the rapid spikes in the bid-ask spread whenever positive news breaks regarding the H200 or the new Rubin architecture. The market is coiled like a spring. The reality is that we are seeing a shift from training AI to inference AI. Training requires a lot of chips at once, but inference, the part where the AI actually answers your questions or generates your images, requires a permanent and massive installation of hardware that stays on 24/7. This transition is going to provide a much more stable and recurring revenue stream than the lumpy one-time sales the bears are predicting. To understand where we are going, we have to look at what Nvidia actually does beyond the headlines. At its core, the company designs and sells high-performance graphics processing units and the networking fabric that connects them. In 2025, they solidified their lead with the Blackwell architecture, which offered a massive leap in energy efficiency and raw compute power over the previous Hopper generation. But the real genius is in the NVLink 5 interconnect. It allows hundreds of GPUs to behave as if they are one single giant chip. This is why a startup can't just buy a few chips from AMD and expect to compete. If they aren't using Nvidia's networking, they aren't going to get the same performance. This is the system approach that has kept Nvidia at a 90% market share in the data center. Even as companies like Amazon or Google try to build their own custom chips, they still find themselves coming back to Nvidia for the most demanding workloads. It's a bit like trying to build your own car versus buying a Ferrari. You might get from point A to point B, but you're not going to win the race. Looking back at their historical performance, Nvidia has been a once-in-a-generation winner. 5 years ago, the idea of a $4 trillion market cap seemed like science fiction. Yet here we are, with the company rivaling the size of the entire German economy. This growth wasn't just fueled by hype, it was built on a series of calculated bets on the future of computing. When Jensen Huang talked about accelerated computing a decade ago, most people thought he was just talking about better video games. Now, every major bank, pharmaceutical company, and government agency is using their hardware to solve problems that were previously unsolvable. Whether you're using the Robinhood investments tool to buy fractional shares or managing a complex strategy on the Fidelity mobile app, you are participating in what might be the most significant capital expenditure cycle in human history. The sheer scale of the investment into these AI factories is hard to wrap your head around, but the quarterly reports don't lie. As we look toward the next several months, several catalysts are on the horizon. The first is the earnings report scheduled for February 25, 2026. Analysts are already whispering about a beat and raise scenario. The consensus EPS is currently around $1.45, but given the reported strength in the Blackwell rollout, we could see a number much higher than that. The second catalyst is the 2026 Consumer Electronics Show and the subsequent GTC conference, where we expect more concrete details on the Rubin GPU. If Nvidia can demonstrate a 3x or 4x performance gain with Rubin, the current valuation will look like a bargain in hindsight. However, we must also consider the risks. Geopolitical tensions, particularly regarding export restrictions to China, remain a dark cloud. While Nvidia has developed specific chips like the H2O to comply with regulations, any further tightening of those rules could impact a significant chunk of their revenue. There is also the risk of AI fatigue among investors if the big tech companies don't start showing clear returns on their massive infrastructure investments soon. If Microsoft or Meta starts to pull back on their spending, Nvidia will be the first to feel the pain. Comment below how many shares of Nvidia stock you currently hold in your portfolio right now. I'm curious to see how many of you have been riding this wave from the early days versus those who just joined the party. It's always